Well, you're all very welcome to today's podcast with Diarmuid Corcoran of Chartered Capital, where we'll be talking about money and especially money in relation to company directors. So if you're a company director in Ireland, especially Diarmuid, this is for you to find out how to best use your money and to use it in a very efficient manner, both personally, I would say, and for the company as well. But before that, just to introduce Diarmuid Corcoran, how are you there, Diarmuid?
Good, Brendan. Good to talk to you again. How are you keeping?
You not only have a background in financial advice and advising company directors at a very high level, but you've also got a background in chartered accountancy with the likes of PwC, for example. That's correct, isn't it?
Yeah. I did my time there with PricewaterhouseCoopers, and yeah, I enjoyed it. You know, the whole accountancy thing, but I've gone more into financial advice, and more specifically, financial advice to company directors is probably what floats my boat at the moment, Brendan. Anyway, you know. So yeah.
Okay. It's an important issue. Is it an issue that some directors you find bury maybe, and they would face operational issues for their company first before looking at the mechanics of finance? Or how do you find the reaction from company directors?
No, absolutely. I mean, look, first and foremost, you know, company directors, their priority is their business. That's their baby, and I suppose a lot of directors see their company as their pension. You know, but I suppose when it comes down to it, that money that they build up, please God, in the company needs to be extracted. And where I come in, I suppose, is trying to help those individuals extract it in the most tax efficient manner possible. There's a number of opportunities out there that I see them being overlooked regularly, very regularly. You know, so and there's a few little things that you mightn't be in a position to, for example, pay into a pension today, or you know, set in place some kind of a corporate bond or whatever. But the reality is, there's steps you should be taking today that'll keep those options on the table down the road. And I know we might touch on these in a little bit, but something like, you know, retirement relief, whereby you can get out 750,000 euros out of the pension, out of a company, completely tax free. There's a couple of boxes to be ticked well in advance of the day that you need to do that. You know, and the more it's about keeping options open, and I try to have those conversations with lots of time in advance, because if you come to on a Monday trying to get the money out on a Friday, and you don't tick the boxes, you're snookered, you know.
Okay. So we're going to have a few of these videos. There'll be a series of about 3 or 4. And I guess the message at the very start of it, Diarmuid, for company directors would be that it doesn't really matter. A lot of company directors might say pension, a lot of money to go into that. That's not for me. But at the other end of the spectrum, you will have people who are maybe paying a lot into their pension at the moment, might say, well, I'm sorted here. But actually, we're going to deal with issues that will focus on all ends of the spectrum, because you're saying even if you don't at the moment, or you're not in a position to invest heavily into your pension, there are steps you can take and should take
Absolutely.
to make sure that, you know, when the time comes, you're actually ready and secured on it. And on the other end of the scale, there are ways that you're going to talk to us about to extract correctly and efficiently out of your business if you are in a position and ready at that end. Let's start with common mistakes, Diarmuid. So what are the common mistakes, or the oversights maybe, that people make when they're trying to extract money from their company, and in a tax efficient manner?
Yeah, I mean, look, front and center, by far the most common mistake I see is company directors not taking a wage or not taking a salary from their company. So essentially, what it comes down to qualify for, we'll call it retirement relief, entrepreneur relief, maximum pension funding, all that kind of thing, where revenue dictate is, what revenue dictates is being serviced is somebody that's taking a wage or a salary. Schedule E income, essentially, a taxable income. And I know, you know, people in Ireland, we've, you know, a very, very progressive, if you want to use, we can think of other words for it as well, but a very progressive tax system, whereby the more you earn, the disproportionately more you pay in tax. But like, and people are reluctant to take an income from their pensions or from their company, whereby essentially they're going to have to pay tax on it. But the reality is, even if the company isn't in a position to pay into a pension at the moment, you're building up what's called service to your company. And when the ducks get in a row down the road and the company's doing well, there's a sum to be done there, and the sum is based around your age, your sex, your marital status, any existing pension benefits, to name a few. Once that sum is done, we can then really look at extracting money from your company in a tax efficient manner. But where, to emphasize the points, but where I see people falling all the time is someone might have a business as a sole trader, they incorporate the machinery, the whole lot. Then they have a director's loan into the company. So they say, listen, I'm not going to pay any income tax for the next couple of years. I'm just going to pay myself back my director's loan from all the assets I incorporated. So someone could be working 12-hour days for 10 years, and the only income from the company has been the repayment of their director's loan, which is a paper transaction. But when it comes to it, the revenue go, well, according to our records, you've never worked in this company. You're a director, but you never worked there. And you might have closed off a massive opportunity. I had a case literally last week where a gentleman sold his company for 2 million, and was applying for entrepreneur relief, which was, I suppose, Brendan, just to give you a bit of high level background on entrepreneur relief, is if you sell a business, you can basically, where you tick the boxes, you can benefit from reduced rate of capital gains tax of 10%, whereas the effective rate for everyone else is 33%. But by that oversight, he like that, he wasn't on the payroll for the last couple of years. He didn't qualify for it, and on £1 million, he paid 300. He's going to have to pay 330 grand in capital gains tax.
Okay.
That could have been 100 grand. That's a 230 grand saving.
230 grand.
Yeah,
straight away.
If he got his ducks in a row, his wife could have been on the books as well. And that's straight away, it's double that. Do you know what I mean? So he could have saved 460 grand in tax that he's now going to pay. So
but maybe people listening will say a couple of things there, Jim. They'll say, well, to be honest, I can't afford to pay myself a salary, or I don't. I think that is not an avenue I want to go into. What would you say there?
Well, I mean, there's nowhere is it set out by revenue. Is there a minimum amount? I mean, you could be talking €100 a week. I mean, you're just about building up that service. So then 20 years down the road, you look back and, oh yeah, I have a pay slip here that says I was getting €100 a week back in 2021. So that's that box ticked, my service, So it doesn't have to be a huge amount. You know what I mean? It just get on the payroll, and even at that, even if you couldn't pay yourself €100 a week, pay the tax on it as if So you'd file a return to state that you paid yourself €100 a week. You pay the tax, so you're paying 50 quid a week or whatever. At that rate you wouldn't even be paying at the margin rate. You're paying at 20%. You probably wouldn't even go into the higher any kind of a tax bracket, but you'd be paying very little tax. But the company would be building up a director's loan that when the company has the money, you take it out and pay yourself. But it's it really is worth making every effort to pay yourself something from the company.
And what if people get into the mentality of or think that, listen, what good is it for me to be paying €100 a month or a week or whatever for X amount of years? For my pension is going to be pathetic at that stage. Can you tell us again how at the end you can write that?
So for company directors have far greater flexibility than your typical employee in terms of what they can put into their pension, right? So as employees, right, as an employee myself, up until not that long ago, the most I could put into a pension was capped at, it's based on age-related limits. So I'm in my 30s. So let's look at my scale here, having the wall, 20% of my income is the most that I could put into my pension, and that's based off the lower of 115,000 or my income, 20% of that figure. Directors, those rules don't apply. So I suppose back to your question for the director, you might be only putting 100 quid a month in now, or 100 quid a week in now, paying yourself. If you fast forward the clock 10, 15, 20 years, if the company takes off, there's a bit of financial engineering to be done at the latter end, going, wait a second. I mean, you could, and I have seen it, whereby essentially someone in their late 50s never had a pension, but they're paying themselves a decent wage, and all the numbers aligned. They're building up over a course of 4 years. They built up over the course of 4 years about 200,000 in their pot, and extracted it completely tax-free. So they only built up at the very end. So they're paying for pension at the very end of that term, and then they extracted out completely tax-free. So they literally had the pension for probably 35 years, had it for 4, and saved, got 200 grand that was sitting in the company today. I was going to say they'll have it in their bank account tomorrow. With the admin, it'd probably take 2 or 3 weeks, but I mean, that's how quickly it would happen though. So you might only have a pension for 2 or 3 weeks, and you'd have 200 grand in your back pocket free of tax.
And a key point you made there as well, which is very interesting, when I pick up on it, is to get your spouse on the payroll. So, for example, there's a lot of people there whose wives or husbands maybe are licking the stamps and putting them on envelopes or whatever, but uh, actually a recognition of whatever small little bit of work that they would do in the smallest way
Yeah.
would mean what at the end of
So it's, yeah, it had the very same options really. It'll come down to ownership of the company is a factor, right? But just on the to qualify for the reliefs, like the retirement relief. Sorry, just on retirement relief, Brendo, and that's something whereby you can take out once you tick the box. It's a bit more stringent than entrepreneurial. You have to be over the age of 55. You have to be working in the company. I think it's 5 of the past 10 years, and this kind of stuff. It's a bit more stringent, but if both husband and wife tick all the boxes, that's 1.5 million out of the company down the road. But again, she likely wouldn't qualify for that relief if she wasn't working in the company. And as I said, working in the company in the eyes of revenue, you're only working in the company when you're getting a wage, not if you're a director. And even if and that's the key point.
Yeah. But listen, stamping the letters and getting your €100 €100 a month, is that too small? That works.
It should work. It's not set out that I'm aware of anyway. That, you know what I mean. That you're building up service, and then you can €100 a month in 20 years' time. You could be paying 100 grand a year, and then that's when you take out the money tax efficiently. But it's about keeping options on the table.
Keeping the options on the table, and it's the difference between realizing very significant pension and really half of that, isn't it? Without.
Yeah, I mean, look, we had the pension time bomb here in Ireland. It's there was plans in place to make it compulsory. I think COVID and everything has set that back. There was auto enrollment was the name of the new pension scheme that the government are trying to implement, but that's been delayed yet again. So essentially, for every pensioner we have in Ireland at the moment, I think it's between 4 and 5 pensioners. Sorry, 4 and 5 employees support every one pensioner. In 2050, we're going to be down to 2. So basically 2 employees are going to be supporting one pensioner. And what that in reality means is, we won't be getting the pension at age 68 or 69. We'll be in our 70s. And when it does start coming, it's going to be less than what it is now in real terms. Yeah. So there is a pension time bomb coming, and by taking control of this yourself, you won't be dependent on the state to provide it for you as much,
Yeah. Before I move on to another question, is there anything else we need to look at with regard to extracting money in the most tax efficient manner, dear?
No, I don't think so. Look, it's about options. It's very difficult. If you meet someone, say, where do you want to be in 5 years' time? That classic interview question, very difficult to know. But what this is about is keeping options on the table. Yeah. And then once those options, are all ticked, that's the key point, But I suppose, yeah, wealth extraction. There's obviously in Ireland we have the 20% tax limit and the 40%. It's about going to the max there on that limit every year. Like depending on your age, you can also do an AVC from your company, an additional voluntary contribution. So you could have a circumstance there where someone is basically, just rough figures, a couple with 2 incomes into the house. The one earner is allowed to earn at 44,300 per annum at the 20% margin, and then the second individual is allowed to earn 26,300 at 20%. But if we just stick with the first guy there, the first woman in that instance, they could earn 55,000, we'll say, if there's someone in their 30s, do an AVC, PRSA. So they write a check for their own pension in their personal name, write a check for maybe 11 grand, brings back down their taxable income to the 44,300. So all of a sudden they put a lump sum, they've pushed up their own income for the purpose of calculating how much they can put into their pension as a director. Yeah. And also they're in their personal name, they haven't gone into the higher rate of tax. So look, there's a couple of, you know what I mean? This is, I suppose, where, to be honest, is where I come in to do those sums for people. Yeah, so listen, this you should be paying yourself.
Yeah. Okay. That's very interesting. What about people who move, maybe work and have a pension with the former employer? What should they do in relation to that pension?
Yeah, it's very common. I think there's this huge money sitting in what do you call it? They're called essentially paid up members of former employer pension schemes, for example, or Like
Yeah.
you leave a job, and the way it's happening, like the day is long gone now, whereby you start a company at 22 or 18 or whatever, and you worked there for 40 years. People are going to start amassing. People tend to turn over in jobs probably on average between 5 and 6 years now. I'd say, I don't know, something like that, but it's going to become an issue. But what those individuals can do is they can contact their ex-employer, ideally the trustees of their former employer's pension, and say, listen, you request what the name of the document, Brendan, is a leaving service option statement, right? You would have got this if you left the company 10 years ago. You would have got this piece of paper about 2 months after you left the job, setting out your pension values, and it was called a leaving service option statement. You now need to basically get onto the trustees of your pension again, ask them for an updated version, and that will set out different options. But one of those options, and this doesn't, nothing here today, I suppose, constitutes official financial advice, but I'm just trying to stress, one of those options is to move it to what's called, from your employer to what's called a personal retirement bond.
Mm-hmm.
So you essentially, your employer, if you could imagine, if you're in your 30s, 40s, 50s, in 10 years time, that employer could be gone, and you're trying to track down an old pension scheme belonging to an old employer that no longer exists.
Mm-hmm.
That can be tricky. You can take that pension, move it into a personal retirement bond, which one of the life companies here, you've Irish Life, Zurich, Standard Life, Aviva, the whole lot, and it's in your personal name, and you don't need to worry about tracking down that pension in that scheme at retirement. You have full control of it today, and likelihood is a lot of those schemes have very limited investment choice. So you might typically have high, medium, and low risk, whereas you can take control of this yourself through your financial advisor, and over that time frame, you never have to worry about, God, who will I ring now in 30 years time when that pension, when I'm trying to find that pension. It could be in your personal name from today. Now, I don't mean in your personal name in your bank account, it'll be in your pension in your personal name, which you'll have direct access to. And the thing about those personal retirement bonds is, as well, is they're accessible from age 50. Now, that's not necessarily always the right thing to do. In fact, it's rarely the right thing to do. If you're still working and you've no need for the money, don't access it, because once you access it, once it's gone, and that's just something to think about. But there's definitely a lot of merit in trying to take control of old pension schemes and bring them into your personal name.
Okay. And finally, for today, right, what about people who don't believe in pensions? And I'm sure you come across a lot who would say, listen, they have other things in mind or whatever, but they don't believe in pensions. What would your take on that be?
Yeah, I think the pensions got a bad rep, I suppose, back 08 or 09 in particular. But like, diversification is where people went wrong, I suppose, really. And and it wasn't their fault. They got bad advice in many instances, a lot of instances. But if you get in early and be diversified in a globally diversified portfolio, equities tend to deliver the best returns over the longer term. Past performers not being a guide to future returns and all the rest of it. But if you don't believe in a pension, I mean, I just think back to that example there again of that individual that essentially built up 200,000 in their pension over the course of 4 years and got out tax free. Another individual, if the numbers align, you could essentially have no pension today, and if the numbers align, write a check for 200,000 to your pension and have it taken into your pocket tomorrow. You don't have to build up for 4 years or anything that's a pension structure. Do you know what I mean? So what I'd say to someone like that is, okay, you don't believe in pensions, but what if I told you I could get you 200,000 into your pocket tomorrow after tax? Are you still anti-pensions now? That kind of way, and the greatest respect, but it just gets a bad rep, and the media, I suppose, can double down on bad news stories. But the key to Anthony, I suppose, and this which it stands up in outside the pension as much as inside the pension, is diversification. Diversify, and it's you shouldn't have all your eggs in one basket ever. And no matter how strong a belief or how good something looks, you really need to spread your wings. And it's like the way the bank shares, we all know what happened then back in 08 or 09. But the problem wasn't investing in bank shares. The problem was only investing in bank shares. If your bank shares accounted for 5-10% of your overall portfolio, the rest of the portfolio, provided it was well diversified, would have well more than compensated, probably doubled your money by the stage.
Yes, yeah.
So
to diversify and to take a longer view, really, isn't it?
Yeah, exactly. And I suppose the thing about it is, as you're nearing retirement, you start de-risking. Pensions can be seen as high risk, but when you're young, you're like, realistically, there's going to be a correction on average between every 7 and 10 years. There's a correction in the markets, but the trajectory has consistently been up, and then the markets tend to crawl forward 4 steps, jump back 1, crawl forward, jump back 1, and then if the jump back 1 is the one that gives the big fright, we had one in March of last year. But if you move to cash you know, the market fell by 32%. If you moved to cash at that point, you gave yourself no chance of recovery. But if you're looking at the window and had the news turned off, you'd be well up today, depending on your portfolio, you know.
Okay.
So,
Diarmuid, thanks very much. Now we'll have other videos in this series, so to come back to it. And if anybody wants to get in touch with you, are you still dialoguing with clients or new clients, or how is it
100%,
working for you?
I've charteredcapital.ie is the website, and if anyone wants to have a chat, there's a link there to my online calendar. You can book yourself in, and we can do a Zoom or a phone call or whatever. I'd be glad to have a chat anyway, you know.
Brilliant. Diarmuid, it's been a pleasure. Thank you very much.
All the best. See you then. Good luck.